Thank you, Graham. I'm very grateful for the opportunity to speak to you this morning about investing in Australian agriculture, an investment space we are deeply passionate about, and a space that Warrakirri has been investing in for over 25 years, with 5 active investment strategies totaling $2 billion in funds under management and commitments on behalf of domestic and global pension funds, family offices, charities, and individuals. I've been tasked today with setting up today's panel discussion by providing an overview of the Australian agricultural investment landscape. Next PowerPoint, please. To give you a feel for what good looks like and characteristics of successful agricultural investments, and talk about real return expectations and potential value of adding agriculture into investment portfolios. Thank you. Now, you can broadly allocate Australian agriculture into 5 categories, which in their own right have many individual subcategories. But to keep it simple, the main sectors in Australian agriculture can be categorised as livestock, crops, horticulture, forestry and aquaculture. These sectors combine to contribute just under 70 billion in gross value and 3% of Australia's GDP, and span some 86,000 farm businesses across 460 million hectares. Interestingly, and probably surprising to many, Australian agriculture is identified as the fastest growing segment of the economy, with 7% real growth over the past 20 years, underpinned by rising demand and price of food, and the trend to higher quality food, particularly from our developing nations at our doorstep. Our proximity as an industry and ability to service these key markets, and our reputation for producing high quality food. And fundamentally, it comes down to the fact that agriculture covers 55% of Australians' land mass, and a large percentage of our agricultural land remains quite underutilised, and significant productivity can be unlocked with further consolidation and investment. Thank you. Australian agriculture has had a long history of institutional investment, particularly overseas investment, with external capital playing a critical role in developing many of our industries. But despite this long-term investment, we still consider the Australian agricultural investment landscape is quite immature and a space with significant growth potential. We estimate the investment universe to be roughly 700 billion, made up of farmland, forestry, water, aquaculture, infrastructure and debt, with the 2 largest segments of the market being farmland and water, accounting for 480 billion, or roughly 70% of the investment landscape. Like many asset classes, your investment options are many and varied, depending on your objectives. Thank you. Agriculture is supported by strong thematic tailwind, but it's not enough to make a successful investment. It takes a lot of skill and experience to develop a successful strategy and then execute it well. Based on our 25 years of experience, there's 8 characteristics of successful agricultural businesses we thought worth sharing and discussing today. Firstly, people matter. Highly skilled people are the single greatest return driver of investment performance in agriculture. This has long been true, and we do not see this changing. Experienced managers and investment personnel are the difference between poor and very attractive returns. And as consolidation continues, asset scale and business complexity rises, the demands on this labour resource and professionals increase, and the skill required change. So successful ag investments need a big focus on people and the enhancement of these skills in the industry. Secondary, scale matters. Larger and more sophisticated businesses generate significantly higher returns. With scale brings greater level of productivity, lower cost of production per unit of output. And quite simply, fewer farmers are producing more. Over the past 20 years, the number of farmers in Australia has halved, while the value of the output has doubled. This is nicely highlighted by the fact that 10% of Australian farmers produce 50% of our output and generate very attractive returns, That's quite remarkable. 10% of Australian farmers produce 50% of the output and have very appealing returns, whilst 50% of the Australian farmers produce less than 10% of the output and produce ultimately lower and uncompetitive returns. Diversification matters by location, climatic zone, commodity produced, end markets are significant factors in developing a high quality agricultural investment. Scale plus diversification is the optimum. That's key. And then the ability for a business to cost effectively and efficiently access multiple supply chains and markets is becoming increasingly important. If we go to the next slide, grouping the next three together in the interest of time, our experience is that agricultural investments committed to environmental sustainability, positive social impact and responsible management, who invest significantly in long-term R&D and innovation and are disciplined in their buying, produce ultimately higher returns and sustainable long-term returns. And lastly, patience. This is not an investment space for speculators and short-term investors. Investors need to have a true long-term perspective and be prepared to invest through a cycle to maximize the opportunity. Thank you. Okay, so let's talk about those returns. Despite what you might read and think, it's our experience that high quality agricultural investments produce very attractive returns. Over the long term, our clients have produced very competitive risk-adjusted returns, with 10-year numbers exceeding index returns for all asset classes, with the exception of global equities. 150 basis points higher than equities, Aussie equities, 50 points higher than property, but importantly at half the level of volatility of these listed stocks. Over our 25-year, which is our longest track record, we've had 2 negative return years in 25 and sits at a standard deviation of about 5.5%, which is similar to bonds or fixed income. And agriculture is certainly uncorrelated to traditional asset classes. It beats to a different drum. It is effectively zero correlation with most asset classes and a very minor positive correlation to property. Agriculture provides strong defensive characteristics. I enjoyed watching some of the other presentations around what are the different defensive assets available, and we think agriculture is a really good option to consider. Agriculture performs strongly in periods of inflation and is less impacted by financial market shock events. In inflationary periods, agricultural commodities are positively correlated to inflation, and agricultural land offers strong diversification attributes as a hedge against Aussie equities, bonds, and cash returns. Historically, bonds, cash, and agriculture have performed most strong in periods of financial stress and shock events. And then from a negative point of view and risk point of view, a period of sustained high Australian dollar coupled with high interest rates locally have the potential to lower agricultural returns most significantly. On to the next, thank you. This chart is an assessment of our risk return profiles of the various agricultural investment available to investors. The size of the bubbles illustrate the potential meaningful investment that you could achieve over a 3 to 5 year period. If you start here with farmland own and operate models, an allocation of 50 million or less is likely to buy you one asset in a climate zone, serving only a handful of markets. Your experience is likely to be volatile and returns ultimately lower around the 5 to 6% mark. Again, scale and diversification is critical. As scale and diversification increases, returns become quite attractive. An investment of 250 to 500 million in an own and operate strategy can produce total returns around the 11% mark, with significantly smoother profile and standard deviations around the 5 to 6%. These returns are further improved with further investment around the $1 billion mark, with realistic returns achievable around the 12% mark through a period of cycles. If you'd like to be in farmland ownership and your long-term allocation size is at the smaller end, we would suggest a consideration to a pooled fund to gain access to the scale and diversification, or considering a leasing allocation. Farmland leasing are models that are a very effective way of accessing diversification benefits of rural property without the volatility of the operating risks and the need to be quite so big. Outside of farm land ownership here, there are a grouping of agricultural infrastructure, forestry, water, secondary credit, and all achieve quite reasonable returns around the 6 to 8% mark. And then, as you'd expect, private equity and development in the higher risk, higher reward bracket to the right-hand side. Thank you. If you now compare a well-scaled, diversified farmland ownership return profile, and this is real return data from one of our long-term clients, against other asset class index returns over the past 10 years, you can see that it performs very strongly. Farmland is producing competitive returns at around that 11% mark with a very low level of volatility in comparison to property equities and even infrastructure, which has long been held as a safe haven and a low level of risk. Thank you. When investors add high quality farmland into a balanced portfolio, members' returns improve, and that's our experience. Based on 10-year actual return data, a 5% allocation to one of our agricultural investments lifts the portfolio return by 10 basis points and improves the portfolio Sharpe ratio by 7.4%. And you can see here clearly a greater allocation towards 10% lifts the portfolios even further. Thank you. So in summary, before I pass on, agriculture has a really bright future, and with very attractive returns available for credit that is patient, that carefully selects an appropriate strategy, and partners and their investments. So I'll pause there and pass back to you, Graham.
Thanks, Adrian. That was a really good overview of the opportunity, the structure, and particularly stunned by the significant growth rates in agriculture. I think that will be new news to a lot of people watching today. Now we'll hear from Liz O'Leary from Macquarie Asset Management. Thanks, Liz.